So a common question that comes up in the smart money community is what should you use as your entry, an order block or a fair value gap? So in this lesson, we're going to compare and contrast both to a sample size of a quarter, which is 3 months, and see which one is more beneficial to implement in your trading plan. So to conduct an unbiased, accurate study, we're going to use the highest quality of order blocks. So in this case, we're going to use this one. Why would we use this one is because this order block is solely responsible for breaking out of the shelf. So what is the second clue now? What is another factor that can validate this order block? The reaction. This bearish reaction is much greater than any previous bearish reaction. And of course, we're going to strictly target extreme order blocks. So let's cover what an extreme is. So let's talk about range extremes. So what you would do, you would split your range into two parts, your premium and your discount. So within your premium and discount ranges, you need to break those in half. Now you have the extreme of your premium range. And this is where you would be looking for a high probability order block sell. Here is a extreme of a discounted range. And here you would be looking for a high probability buy, which would be your high probability order block. So for this study, I strictly used extreme order blocks. So out of these two order blocks, I would use the extreme, which would be you pull out your fib, break your range into quarters, which is your last swing high, your last swing low, and break it into quarters. And look at which order block is located in your extreme. In this case, this order block is located in the extreme, which is the bottom quarter. So the results backtesting your USD using our high probability order blocks over a span of 3 months, the results were 6 out of 12, which is 6 wins out of 12 setups with an average risk to reward of 3R. And time frame wise, time frame is dynamic. Why is it dynamic? Because economy is dynamic and foreign exchange currency is economy. But if you want to average it out, my higher time frame was around 9 hours and my entry was around 30 minutes. So let's go over high probability fair value gap scenarios. So in this case, we're going to pick this fair value gap. Why would we pick this fair value gap? Because in my experience, fair value gaps work the best when they happen post a compression or a stop hunt. In this case, it would be this compression. So let's see what makes a high quality fair value gap. So what is a compression? A compression is a complete mitigation of extremes. So let's say you have a demand level here, price mitigates the extreme. You have another demand level here, price mitigates it. So it's basically a cleanup of all extremes. So when price does break out of this compression, which is this entire thing, price forms your fair value gap right here. Remember, after your compression. If it occurs before breaking out of your compression, this is an invalid fair value gap. So when it happens post your compression, when price does come back to your fair value gap, it's a higher probability for price to reject and continue higher. So let's take this fair value gap as an example. Why this specific fair value gap? Because it's post a compression and it was after the breakout. So you have your breakout right here. This fair value gap happened after the breakout. And where's your compression? Here's your compression where everything got mitigated. As you can see, this high got mitigated here and then this high got mitigated here. So all the extremes got mitigated. So this breakout was a validated fair value gap. So the results for the fair value gap study was 5 out of 13. So 5 fair value gaps out of 13 worked with an average risk to reward of 2.3. And as far as time frame goes, like we said previously, it was dynamic, but if you average it out, My macro was the 6 hour and my entry was the 30 minutes. And when using fair value gaps, you always want to use a lower time frame than when you use an order block. So the last part of the study was the overlap. The overlap is when a micro order block occurs in a higher time frame fair value gap. And the results for that study was 2 out of 4 with an average risk reward of 5.6. So to conclude the study, the extreme order block and the overlap are tied at 50% when it comes to strike rate. Frequency-wise, fair value gaps occurs more often than the other two, but with a much lower strike rate. And the risk reward goes to the overlap. Even though it occurs less frequent than the other two, it has the highest risk reward. So I hope you guys enjoyed this lesson. Make sure you like, share, and subscribe, and drop a comment. What video do you guys want next?